afternoon, everybody. Welcome to your Monday edition of the TraderMerlin Show. My name is Merlin Rothfeld, and today we are going to talk about bonds and interest rate products. Joining me I guess from the East Coast. I never know exactly where he's at because he does travel a lot to do his teaching. We've got a gentleman who's no stranger to the program. He's been doing this for quite some time, coming on here probably once every few months to enlighten us on what's going on. We call it the Bond Market Breakdown today with Mr. Bill Addiss joining us. Bill, how you doing, my friend?
I'm great, Merlin. Good to see you and great to talk to your peoples.
Yeah, it's good, and you always give us some good, insightful stuff to go over. Before we dive into any of it, I actually have a very simple thing that the question came in, but I didn't get a chance to put it in the slides, and it was, I hear all this time about treasuries and notes and bonds. Are they all the same thing, or are they different? We'll just start with the most elementary we could start the show with.
All right, that is literally Bonds 101, which I want to come back to that topic because we're going to do a whole session on that in my XLT tomorrow of bond basics. So this is like a perfect segue. But no, when we talk about a bond, a treasury is a type of bond, just like you could have a corporate bond or muni. So the broad category is bonds. Now the subset below that is treasury securities. But then within that, you have a variety of different instruments. You have treasury bills, treasury notes, treasury bonds, tips. Those are all examples. So that, we work on a top down: bonds, treasury securities, and then bills, notes, bonds, tips, and strips.
Mm-hmm. And basically all those references different lengths and maturities, right? It's a way to kind of classify different durations.
Exactly. Yeah, the biggest significant, with the exception of the tips, the biggest difference in them is simply maturity. When the U.S. government issues anything with a shorter than 1 year maturity, that's a treasury bill. So we do a 1 month, a 3 month, a 6 month, a 1 year. Those are treasury bills. Anything longer than a year is a note, and that goes out to 10 years. So in today's market, on a monthly basis, because of the deficit, every month we issue a 2 year, 3 year, 5 year, 7 year, and 10 year note. Then anything longer than 10 years is like a trivia contest.
Right.
Then anything longer than 10 years is a bond. And the only actual bond the U.S. government sells is the 20-year and the 30-year. Unfortunately, to complicate things, many people like myself, we tend to call everything a bond.
Right.
And, when I'm teaching or we're talking with a new audience, I too should be more specific. But unfortunately, we do tend to generalize and call everything a bond. Right.
And that's changing as we speak now. I mean, you talk about some that I think last year you and I were talking about how there were some new treasury products coming up and they were making some new bonds. What was it, 50 or 100 year or something like that?
Correct. Yeah, we've had other countries recently have started even offering longer maturities. UK regularly issues 50-year maturity bonds. Some Europe is starting to. Mexico is now issuing 100-year maturity bonds. That's perpetual debt. We call that an optimus bond. If you think you're going to see that mature, but that's perpetual debt. See, the benefit is if a government issues 50-year maturity bonds, then we have a benchmark that corporations can use. See, here in the U.S., with our government not issuing longer than 30-year, it's virtually impossible to figure out what the correct yield should be if a corporation wanted to issue a longer maturity bond. Mm-hmm. So the truth is, corporations in Europe and the UK now have much greater maturity flexibility, more options than we here in the U.S. And our Treasury Department has told us they're staying at 30. They've addressed us and told us, we don't know why, but they're sticking to 30.
Yeah, interesting, because a corporate, if they're going to issue longer term, they need to have their benchmark to go off of, and treasuries would be it.
Exactly. And we don't have that here in the U.S. past 30 years. So I would love to see them also for the OTA community and for trading purposes. I'd love to see a 50-year treasury because you'd have even more volatility, more duration. Mm-hmm. That would be a fun bond from a volatility point of view. I'd love to see a 50-year.
Yeah, sponsored by the Rolling Stones. Time is on my side, right?
Right, exactly. We're never going to all see them mature anyway, so let's just trade them.
Exactly. Yeah, a lifetime bond. Right. All right, so now we got the basics 101, and of course, as you guys may have heard, the little plug there, he does have an XLT. Is it a general session for bonds tomorrow? Or
yes, general session tomorrow afternoon, and at the request of my last one, it's Bonds 101. Let's demystify all this jargon and terminology and what makes people avoid it and their eyes cross over when they listen to it.
Love it. All right, walk us through a little bit of what you see going on right now. Obviously, one of the things that cracked me up was last September, you kind of this feeling that we're going to have 2 rate increases by the central banks. And then we got some bad information in November. We got some worse information in December. Now it's like, oh, well, 3 in 2022. And now all of a sudden you're hearing some analysts say 5 rate increases in 2022. I know you love the transparency of the Fed. Are we seeing a clear picture of what the hell is going on? Or are we being, I guess, hoodwinked a little bit?
No, I really don't think there's any hoodwinking going on. But let's go with the basic premise that the Fed, I do have to say, and I'm an old geezer, the Fed is offering a level of transparency here today to us that is literally unparalleled. And I hope the OTA community is taking advantage of this. And I have to date myself a little bit. When I first came into the market in 1979, when we had stagflation, which we've had that conversation, and I continue to worry about that. In 1979, the Fed funds rate was at 5%. Mm-hmm. By 1980, it went to 20%. All right. And during that period of time, the Fed didn't tell us what they were doing. I mean, we could see the Fed funds rate was going up, but the Fed has no obligation to tell us what they're doing, make announcements. And under Paul Volcker, the Fed literally would meet like we now enjoy, and they would disband. They would never even tell us what they decided to do. It sometimes took us months to figure out what the Fed was doing. Now we're in an environment where the Fed tells us not only what are they doing at this meeting, they're now giving us projections going out for 2 years. I mean, the level of transparency, the Fed told us we're going to start raising rates soon. Read March there. Yep. All right. Nobody's going to be surprised by a Fed funds hike. For the first time in 3 years, we're going to start seeing rates go up. And the Fed could not have telegraphed this any better to us. And then they turn around and say, and once we start raising rates, then we're going to start tapering, which is to say we're going to start raising long rates. So, I mean, this is the most transparent Fed we could ever have. But here's the problem. Giving economic forecasts as to how many rate hikes you're going to have over the next year or 2 years, there's so many variables. Right. We're talking about, the Omicron crisis. We're talking about other variants, how quickly countries are rebounding. I mean, what the Fed likes to say to us is data determinant. And it's really the same as, do you trust an earnings forecast a year from now as much as you trust an earnings forecast due to come out in 3 months?
Bill, I don't trust an earnings announcement ever.
Yeah. So, the Fed is looking for latitude, and the Fed is saying it's got to be data determinant because they're walking this tightrope. Mm-hmm. Are we worried about inflation or are we worried about the economy? This whole stagflation creates a real problem for the central banks. And I think they're not that they're trying to deceive us in any way, but they are acknowledging this is a tightrope and projecting things out a year into the future. Pretty problematic when you're dealing in unprecedented situations, and this is unprecedented.
Absolutely, yeah. I mean, it's tough, especially just to plan a trade for a week and figure out what the heck's going to happen with price, let alone go out years and years.
Exactly.
You gave me some great charts, which I think might be a good starting point here to kind of paint this picture of what's happening with the yield curve. Some may not know what the yield curve is. It's just basically showing you the distribution of different maturities of bonds or treasuries, as we looked at here, going from the short end all the way out to like 30 years, and different measures of influence on each side of that yield curve. So I'll start off with the one where it kind of says where you're at today, kind of where we are at this moment. So walk us through what I'm looking at here.
Yeah, and perfect intro there, Marlon. Thank you. True professional. But as you said, the blue line represents a picture of where interest rates were this morning here in the U.S. And what you can see is short-term interest rates down at 1 month are at 0. And the further you go out in maturity, the higher the rates go. We have a normal yield curve today. And I sorry, you started to, and I should clarify more. This is taking a picture of what interest rate was available for all those different treasuries I mentioned as of 8 o'clock this morning. So if you came in and bought the 10-year treasury this morning, according to this chart, the yield you would have earned was 1.85%. That's what that chart is showing us, as opposed to short-term interest rates down here at 0. So exactly as you said in your intro, the yield curve is affected by different things. So what I'm going to ask you to do is what I love about this chart, and I got to get a life that I love any chart, but what Guru Focus does for us is they give us a snapshot of 3 years. And right now, this is a perfect snapshot because the light gray line is the Treasury yield curve a month before the pandemic hit. There's February 2020, before it all hit the fan. Then we look at the dark gray line, that's February of 21, right smack in the middle of being shut down. And now here we are in February of 22, hopefully coming out of it. So we got a nice snapshot of before, during, and hopefully post, if you will. And what you see is before the pandemic hit, that light gray line, there's that yield curve that you and I have been talking about now for years, right? Short-term interest rates being higher than long-term interest rates. That was predicting the recession we did get 8 out of 8 times. I'm sure most of your viewers know the story. But then when the pandemic hit a month later, then the Fed took that short-term interest rate and brought it down to zero, the Fed funds rate.
Right.
So the Fed owns the short end of the market, and they brought that interest rate down to zero, affecting all short-term interest rates.
Right. And the short end for everybody here. Yeah, and the short end is on the left-hand side there, just so you can see that light gray was up at about 1.5%. Well, in the period of just a few months, that got ripped from almost 1.5% to zero. I mean, it was just straight down, and of course they manipulated that. And for those that don't understand the importance here, when you look at something like the yield curve, especially this one in gray, what that's telling you is you could invest your money for 1 month. You could buy a 1 month bill, right? It's a bill for that short term? Yeah, okay.
Yep,
you could buy a 1 month bill and get 1.5% interest annually, right? But so it's kind of be chopped up by months. And that's going to pay you better than if you locked up your money for 2 years, 5 years, 7 years, 10 years. I mean, that's not a good sign if you are going to earn a lot of money in the very short term versus long term. It means that the prognosis for the future is not good, and that's what that light gray line represents. What's noteworthy is the dark gray line. You can see how real quickly it shifted. And these are the light or dark gray and blue are normal yield curves where short term is lower. What's interesting is how in the last year, from February 2021 to current in blue, how it's kind of bubbled out a little bit. And to me, it's arching its back a little bit here in kind of those midterm ones, the 2, the 3, and the 5. What does that tell us?
Wait, what that is really boding, honestly, is the prospect of inflation. And the fact that inflation has reared its ugly head so quickly and so voraciously that the marketplace is pricing in the Fed hikes even before they do it. The marketplace is pricing in that these short-term rates are going to be escalating very quickly. Now, when you talk, though, and I don't want to confuse people, because you mentioned earlier that, in the market we were predicting 2 rate hikes. Now we're looking at 4. Potentially.
Right.
That is partially coming from what you're looking at here, but more specifically, that type of data comes from the futures markets, where we've got Fed funds futures, and we can see more specifically. But that same effect of short-term interest rates going up fast, quickly, is being expressed in this yield curve as well.
Yeah, it's to me it's very interesting because this does paint the picture for everybody that things are getting more expensive, and I think that's it's not a shocker. None of this should be catching anybody off guard as long as you kind of prepare for it. I think many of us might feel the pinch of inflation a little bit more than others. I had to go fill up my truck today, and the cheapest gas I found is $4.75. I'm like, $4.75, huh? No inflation here, folks. Nothing to see.
Really. Pay no attention to the inflation behind the curtain.
Right, exactly. All right, so we view ourselves, since we are Americans here, most of us. I know we've got some Canadians and others living in other parts of the world, but most of the audience here is Americans. And we think, okay, well, we're the best for the bond market, and everyone else will learn from us. You have another graphic here, which I think is interesting, which talks a little bit about what's going on over in Europe. And Germany has been in a very unusual situation. We've talked about negative yields before, but let's look at Germany. Maybe we can talk about the negative or the rising rate environment, since you had UK has now done 2 rate increases in the past few months. US is just about to. So let's take a peek at this chart and see what you can educate us on.
Yeah, what's interesting to me, and my business has honestly during the pandemic gotten a lot more global than my domestic clients who are now doing programs worldwide. So it's given me the opportunity to expand my horizon a bit more in more depth. And what I find fascinating is that observation you saw of rising interest rates here in the U.S., right? The central bank's basically holding short-term interest rates unchanged, but the market determines long-term rates. And what we're seeing is this upward bias to rates being driven by inflation globally. This inflation problem is not just a U.S. problem. The whole reason the U.K. has done 2 rate hikes now is because they have acknowledged we know it's going to hurt the economy, but we're more worried about inflation. So what's interesting to me, there's a couple of things on this German yield curve. So what we're looking at here is the same thing we looked at with the U.S. Treasury yield curve. The blue line is the sovereign rates for German bunds as of this morning. And again, they too have a 30-year yield curve. And what you can see is by the blue line, they too have a normal yield curve with that bump, that bulge that you were also highlighting in the shorter maturities. But look at that in contrast to the orange line, which is only 6 months ago. Look at how much long-term rates have come up in Europe. And the key factor, what I really would like your reader, your listeners to see, is look at the scale over on the left-hand side.
Yeah.
Right? 0 is 3/4 of the way up the scale. Right? All of those short-term rates, even today in Europe, are still negative. You know, we don't have negative interest rates here in the U.S. Europe experienced it, and that's what you're seeing here. So the central bank in Europe is keeping the interbank rate at a negative rate, not 0 where we had it here. But you can see is as interest rates are going up, driven by market forces in the longer maturities, those interest rates have now finally gotten into positive territory. I mean, look at that orange yield curve 6 months ago.
That's insane.
Every single bond in the German market was a negative yielding bond. And that was one of the factors that was driving a lot of international investors to buy U.S. treasuries. You know, at 1.5%, our 10-year treasury didn't seem like a very attractive yield. And I might agree with that. But if you compare it with negative 0.5% in Germany, suddenly 1.5% isn't looking so unattractive. But now we're starting to see Europe interest rates coming up, and we're now getting, finally, for the first time in 3 years, positive interest rates in Europe again. But this negative interest rate, we've had this discussion before, kind of blows my mind that we had negative yielding bonds. 30% of the market in Europe was negative yielding.
Yeah, that just, it seems so bizarre. I could just picture like some German banker going, yeah, you give me the money and I will pay you nothing. You pay me more money to keep your money. Yes, good idea. It's like, no, hold on a second. I know that was a horrible German accent, and
that
I'm
was
German.
The worst German
that was like Turkish and Iranian, and I went all over the place with that one. But yeah, I mean, try selling that one. Hey, Bill, listen, I could really use some money. If you loan me $100,000. I'll let you pay me, I don't know, 2% interest. So you can give me the money, and then you're going to pay me on top of that. What?
Right. What? And that's why, honestly, and you know, and I thank you for setting it up, because I get so many questions about this. I mean, think about it. Just as you said, how could you logistically have a negative yielding bond? I sell you a bond, right, and then you're going to pay me money? You know, how do I know you can? How do I know you can afford it? Right, at a negative interest rate. How do I know you can pay me? So understand, governments and corporations don't issue negative yielding bonds. So I thought, if we could take a moment and explain how this happens, because it comes up a lot in the lectures. So real quick. There's a type of bond in the market, and I switched slides on you, Marlon. I don't know if you did too. I'm sorry.
I'm always one step ahead of you, buddy. We're good. We're on the old negative yield.
I just clicked forward. I realized I'm not controlling your slide. So normally, the way a zero coupon bond works, and we have a lot of them here in the U.S. You might have heard of strips and things of that nature. A T-bill is also a zero coupon instrument, because what happens on a zero coupon instrument is you pay less than $1,000 for it. And they always mature at 1,000, just as part of the Bonds 101. The unit that bonds all come in is $1,000, whether it's corporates, governments, munis, $1,000 the value. And that's called the par value, the notional. This is all part of that jargon. So the unit of a loan, the unit of a bond is $1,000. So normally when you buy a zero coupon bond, you would pay less than $1,000 to buy it. Then when the bond matures, you get the full value of 1,000. The difference between what you put up and what you paid is your interest.
Right.
It's just that simple. Well, what if a government issues a zero coupon bond, like Germany has been doing, and investors drive the price of that bond up aberrationally high, so that now it's no longer trading at a discount, but it's actually trading above that $1,000 value at a premium to par. So on the example on the slide, right, what if we had a 10-year maturity zero coupon bond that was trading at a price of $1,050? That means you're going to lose that $50 over the 10 years, right? Because when the bond matures, you only get back $1,000.
Right.
So if you're going to lose $50 or 5% over the 10-year period, annualizing that, it works out to be 0.5%. And that was, in fact, the yield on the government Bund in Germany just 3 months ago was 0.5% because the price was approximately 1,050 on their 10-year maturity bonds.
So let me ask you, I think it's still, as many times as I go through it, I just kind of shake my head at like, why would I spend $1,050 for something that in 10 years is going to be worth $1,000? And the only thing I can come up with is that I'm so fearful about the value of my currency that I want to make sure I at least get $1,000, because if I just hold on to it through normal investments, I might lose 20 or 30% of that due to inflation or market action. Would that be kind of the reason?
Absolutely one of the factors. Absolutely. This reflected a fear in Europe, going before the pandemic even, that the European economy was slowing down, markets were overvalued, that there is the ultimate flight to safety, if you will. Mm-hmm. The other problem that you have was all these countries, again, doing that quantitative easing, putting all that cash into the market, looking for homes. Remember, the whole goal of quantitative easing is to bring down interest rates.
Right.
Well, the whole world did quantitative easing, and congratulations, we got low interest rates.
Yeah, and the whole world, it's funny because you said that earlier, and I wanted to kind of emphasize that point. It's like, this is not a U.S. specific thing. I mean, I think we did shows on Power Trading Radio, a few years back, we're saying, look, this is the absolute epitome of a currency war. Every country on earth is just slashing their interest rates to get as low as possible, some even going negative, to help stimulate jobs and growth in their economy because of the financial crisis. And we're still stuck there, which is just mind-boggling to me.
And it's so mind-boggling to me. I have to throw one out there, again, talking more international for just a moment. But, here in the U.S., we're going to start destroying money, right? We're going to start tapering.
Yep.
The U.K. is going to start tapering. Canada has started tapering, where we're destroying money. So we're further along on the economic curve. But right now, Japan is so worried about their economy in Japan because they're in a recession. They haven't come out of this. They've got a problem. They went into the pandemic in worse shape. They're coming out. As we sit here today, the Bank of Japan is printing up trillions of yen, still engaged in very active quantitative easing. I mean, they're printing up boatloads of yen, and they're going out there buying assets. They're buying bonds. They're buying real estate. Bank of Japan's buying real estate. They own 5% of the Nikkei index. They're buying stocks. I mean, to me, for any of your group who's currency traders, no question as to why the Japanese yen is weak to the dollar, right? We're taking dollars out of circulation and going to start tapering. And Japan is just mass producing yen to go out there and buy a boatload of different assets. I hope this experiment works.
Yeah, I question that as well. I mean, if you look back, there's this talk track about Japan. They call it the lost decades. And then it was the lost decade. And then it was lost decades. And now it's like, if you're 30 years or younger, Japan's been in a financial crisis and a recession for pretty much 30 years. Yeah. I'm thinking this. I'm thinking when I revise my trade strategies, or if I'm trying to do something, maybe go look for new work or perfect a new craft like playing the bass or learning a new language. If I've done that act for 30 friggin' years and it doesn't work, I'm pretty sure I got to try something different. Maybe base is not my thing. Maybe financial easing is not it for central banks in Japan. I kind of shake my head. I don't know what the heck they're doing, but I'm not a policymaker. I just laugh at them and point my finger and shame
and I will endorse what you said, because for better or worse, Japan has been more aggressive in trying to. And again, maybe this cure is worse than the problem. But when we were dropping short-term rates.
Right.
Japan was one of the first to try this experiment of negative interest rates. They were the first ones with that, with QE. They're just continuing to pound out the yen, printing up, creating more and more, while the rest of the world has pretty much stopped. They're more aggressive from a monetary policy point of view than anybody, but also in fairness, they need to be, I guess, or I don't know, are they the cure or the solution? I don't know. Are they the solution or the problem?
Oh, yeah.
But they have been aggressive on monetary policies because they just can't turn that economy around quickly
or
stably.
Stably, right. So let me ask you this one. Since you have more experience in bonds than anybody I know, and I value your opinion, I've never seen a situation like what we're experiencing right now. I've seen rates get lowered and rates get raised. But to have this coupling of, I guess, extremely significant inflation increases over a short period of time. Granted, it'll probably level off at some point and maybe retrace back down. But we've seen this parabolic move in inflation. Then you also have the tapering, right? Let's stop buying mortgage-backed securities and treasuries, which is crazy, and corporate debt. And then let's raise rates. It's this, like, for me, my mind just says this is the perfect tornado of events to slam a market that's overinflated. Now, I don't want to change your thought process, but how do you see it panning out when we're making so many dramatic changes to an economy in a small window of time?
No, and I great question, Merlin. And I have to be honest with you. I get almost tired of using the word unprecedented. It seems like every time we talk over the last year, everything is unprecedented. But I would point out, on top of everything that you just mentioned as potential obstacles, I'd add energy prices to that. Right. As a major factor. And everything you just mentioned, boy, doesn't it sound a lot like 1979?
Well, I was a little young. I was still picking my nose at that time.
And I know I've said it before, but I really have to make your audience aware, what stagflation does to an economy. And that's the fear. I know you've had other shows on it. Yep. We've talked about it. I am so worried about stagnation fears and stagnation pressures. I mean, this is not just theoretical. It's happening. Yeah. The question is how deeply we're going to get mired in stagflation. But stagflation pressures are amongst us. And I have to add the white hair we were talking about before we got on camera. I've earned this white hair. In 1979, as I mentioned to you, the Fed funds rate was at 5%. By 1980, it went to 20%. Yeah. Inflation was running at 20%. I'm sure some of your audience were consumers in 1979. We had gas rationing, right? You could only buy cars. Ask your parents, Merlin. They could only buy cars you were too young, for their autos on certain days based on license plate. Inflation was running at 20%. I was a prime mortgage candidate. I'm not bragging, but I had a Wall Street job and no debt. In 1980, 18% for a prime mortgage. The U.S. government issued 30-year bonds, pardon me. They had to pay 14%. Wow. Now the U.S. government issues a 30-year bond, they only have to pay 2%. And the debt on servicing our debt is already our third largest expense, even with interest rates so low. But in 1980, we had to pay 79. We had to pay 14% to borrow money. That's what stagflation does. That's why people like me are worried about it. We've experienced this. Yeah. The tapering. What happened when the Fed stopped tapering in 2013? What happens when the Fed turns off the adrenaline of 0% interest rates? Mm-hmm. Now, I'm going to be very honest. I'm worried that what the Fed did in increasing money supply by 500% in the last year, I'm worried that we have systemic inflation problems, and I've experienced this. I know what this looks like.
Yeah. It's funny, I always use the reference of M1 money supply, and I probably mentioned this to you before, but if you go back into 1950, M1 money supply was 2.5 trillion, and then you fast forward 70 years, 70, to 2020, and M1 money supply was at 4 trillion, right? That's an increase of 40% over 70 years. And now
70 years.
And you're saying now it's 500% in 2 years. You just got to go, okay, this is the old phrase, one of these kids is not like the other. Right. Clearly something is askew here. And, when you do that kind of stimulus, it certainly impacts a lot of the market. And we mentioned stagflation. The three main categories, there's many, but the three main categories for stagflation would be rising unemployment, which we're not seeing that right now, actually. Unemployment is dropping. It kind of stabilized in the high 3%. You have inflation, which we definitely have that. And then you have GDP shrinking. But, the interesting thing, Bill, is, and it's probably skewed because of all this spending, but GDP right now is looking great. I mean, our last GDP number was it looked like China a decade ago.
6.9 for the last quarter was a pleasant surprise. I'll take it. Absolutely.
But
I am going to strongly disagree with you, though, about the employment situation getting better. And we've had this discussion. The unemployment rate at 4% tells us absolutely nothing, because that tells us how many people are back in the labor force who've been out for the last year. So I totally disregard the unemployment number. Perfect. The participation number is still down at below 62%. We still have over 3 million people that lost their jobs in the pandemic that have chosen not yet to come back, and maybe they'll never come back into the workplace. So and my back goes up every time I hear people say the unemployment rate is looking good. No, it's not.
I'm just reading the facts they give me, but you're right. You're totally right.
We've had this conversation. Yes.
And this is why I love having you on. And if I do make mistakes, I'm first to correct them. And yes, the unemployment rate that we see on CNBC and Fox and Bloomberg are all saying, No, it's okay. It looks good. But you're right. When you could even look at the U6 rate versus U3, and it paints an uglier picture. But, if it says, I just pulled up the stats, 61% of U.S. labor force participation as of December 21st of last year. And, when you look statistically of a chart of that, which I didn't bring up, that's declined a lot. I mean, it's certainly
pre-pandemic. We were at 63%. Unfortunately, I know the chart in my head.
I bet
the
you do.
velocity drop that we see during the pandemic basically went from 63 down to 60. We're back up to 61. We haven't made up half the jobs that were lost during the pandemic, and that's a much different picture than looking at the unemployment rate at only 4%, down from 11%, which makes it look so good.
Right. I'm actually going to add it in here real quick, just because I've got a crack researcher here to help me out. His name is Nilrem Delefathor. That's
wonderful.
That's my name.
While you're doing that, I just want to put in a commercial for the Fed. What the numbers Merlin was just reciting of the M1 number. Now, M1 is the amount of cash in circulation. M1 last 2 years, has gone up by 500%. We went from 4 trillion of cash in our economy to 20 trillion of cash in our economy in just 2 years. And really answering your question from before, Merlin, it is my fear as a traditional economist, I'll admit, I'm a Keynesian guy from way back. All that cash is having to find a home.
Right.
And I worry that we've created bubbles.
Yep.
The low yield on bonds right now. I mean, I'm a bond guy. I can't recommend bonds to anybody right now. Not with inflation where it is versus the rate of return. You're getting an unprecedentedly negative real rate of return.
I love that you just said that. It's brilliant you said, I'm a bonds guy, and I can't tell you to buy bonds. It's like going down to a gold deal, and he's like, I don't buy gold today. Don't do it, right? I mean, you rarely see that.
I have that responsibility. There's just no value relative to the inflation. So I think the bond market is overvalued. Personally, one man's opinion, I think the stock market is overvalued. The point is, the actions that the Fed have taken, which were so dramatic in the last 2 years, are putting us in unprecedented territory. So what's going to happen when the Fed turns off the spigot here? That's the $64,000 question to me.
Agreed. Bill, you keep talking like this. I don't know if they'll be letting you teach at the Fed again.
I'm there on June 16th. I'll be back at the Fed. I train at the New York Fed.
I love it.
For better or worse, they like me, and now I'm honest. So I think they like that. I give them credit for that. They have people smarter than me on site. I think they like the fact I'm an independent.
I like it as well. Here is the labor force participation, just so you guys can see it. This is from 1990 to 2021, and you can see, as Bill was pointing out, in 97, 98, 99, during the dot-com era, we were over 67%, and now we are just barely above 61%. And I know that many of you are going to go, well, it's only a 6% difference. That doesn't mean much. Well, when you deal with 330 million people, it actually does mean a significant amount. That's a lot of people who are just deciding not to be in the labor force.
Right. Yeah, this literally measured, the participation rate that Merlin's showing here, measures the entire population ages 16 to 65 and says what percentage of that is working. I think that's a much more important metrics these days than just looking at the unemployment rate, which shows you what percentage of the people who lost their job in the last year are getting employment.
Right, absolutely. I want to go back here real quick and just look at a question since it was put in there, and I want to make sure I get to it, because Margaret says, Bill, twice on this show, you said that Paul Volcker was your favorite Fed chairman. Who's your second favorite Fed chairman?
Boy, the fact that I can even rate Fed chairmen, I really got to get a life.
Yeah, you do.
I have the greatest respect for Paul Volcker, and Margaret's heard the quote that I quote Warren Buffett all the time, who says that for every corporation that survived the stagflation in 1979 period, that corporation should erect a statue to Paul Volcker and everybody genuflect to him on the way into work in the morning, because it's only through his efforts did our economy survive. And I share that opinion. I also have to say, I think Alan Greenspan was a groundbreaker. Alan Greenspan was a really novel thinker. For those who might not be aware, his mentor was Ayn Rand from the University of Chicago, Atlas Shrugged and all of that. Libertarian, free market, power to the individual. She was his mentor. I mean, he even wrote the intro to the last editions of Atlas Shrugged, crediting that book with being his economic manifesto. So I think that's kind of cool. I also like the fact that he brought the transparency that we now enjoy. Yeah. The fact that the Fed holds a press conference, the fact that the Fed tells us what they're doing, all of that transparency was only first introduced with Alan Greenspan. So he was a real game changer. Again, under Volcker, the philosophy was we don't want to tell the market what we're doing. That literally was the Fed philosophy pre-Greenspan. Greenspan said, no. We got to tell them what we're doing. Even, give them minutes of the meetings, show them how we voted. All of that came in about under Greenspan. So I think that took some courage. I think he totally blew it with the dot-com bubble, personally. So, there's pluses and minuses there. Irrational exuberance, remember?
Yeah. I love the irrational exuberance. I mean, the irrational exuberance, when that first came out, I guess we could ask the people here, what year was that quoted, right? What year did Alan Greenspan say the market's under a irrational state of exuberance? You remember?
03?
No. Oh my, 03? Oh, this will be great. Let me bring up a chart of the markets here because this is one I love this one.
Yeah, all right.
Because when you see the chart, I can see now I can't figure out where my charts are. So bear with me as I try to get the charts up and running over here. I got too many things going on. I'm trying to do mission controls. Okay, here we go. So let me bring and I'm waiting actually because what happens is people type it into chat, which makes it fun, and I get to see all their responses. So here is a chart of the market, and I'll be watching your feeds. When did you guys think irrational exuberance was said? Market says 88. Tom says 99. Well, first let's go out and look at, let's look at one of the market indexes. Here, let's just look at NASDAQ futures, see how far back I can go here, and I'll go to a monthly. And we'll scroll all the way back here into the 90s. Oh, I can't even get the index back then. Let me see if I can get the Dow futures. Mine only start back here. This is not going to work. Unfortunately, I won't be able to get the whole history. So I guess I could go to the SPX and get its S&P. There we go. This will do it. All right, so here you guys can see this is leading up to the dot-com bubble. I'm going all the way back into 1963. You can see that we really started to move in the mid-'80s, accelerated in the early 90s, and then really in 1994, we went ape shit. There's no better way to put it, sorry. But he said it, I forget the month, but it was 1996. And here's
really that early in, wow.
Yeah, and that's why I want to point that out, because that vertical line that you guys see, that's when he said it, and the markets from that moment that he said irrational exuberance in the marketplace, which would make you think I got to get out of the friggin' market, rallied a total of 113% from there. So don't think that just because someone thinks the markets are overbought, they can't go higher, right? The lesson learned there.
Exactly. That is the moral of that story.
Crazy one. Let's see. I think I had one more question that came through. That was a pretty good one back here. Should long-term rates go up more relative to short-term rates during an inflationary period? So I guess when we have high inflation, which end of that yield curve should be impacted the most?
Great question, whoever that came in from. And the answer to that is unfortunately only going to be found with how aggressive the Fed feels they're going to have to be bringing up the short end. Because remember, the Fed directly controls the short end. They can bring it up 4 rate hikes of a quarter point each. Boom, we're up by 1% at the end of 4 rate hikes, however long it takes. The long end of the market is going to be responding to other factors. So it is the expectation that if inflation is continuing to rear its ugly head, that yes, that should continue to put upward pressure to long-term rates. But we could get into a scenario, some people are talking about 6 hikes by the Fed next, in the next cycle. Well, you could get to a point where we could get into a flat yield curve. Mm-hmm. That, and then if we get a slowdown, what does that lead to? Another inversion. I don't want to go too far down that road because we got 2 cycles ahead before we get there. But that's what the Fed is going to be looking to see is, how much do we have to bring up short rates? And I guarantee you they're going to be looking at the long end of the market as well. They don't want to cause that inversion.
Right.
And I don't expect they would. Again, long-term rates are already at 2%. So the Fed would have to bring it up that substantially. I'm not seeing that. Yeah. And I'm certainly not personally looking for long-term rates to come down from here. So, the steepness of the curve measuring short to long will be a reflection of what the market thinks about inflation. If that gap continues to widen, it's the market continuing to say inflation's a problem. If that gap starts to narrow, that's the marketplace saying, well, maybe inflationary pressures are easing off as a result of what the Fed is doing, right? What the goal of the Fed is to reduce inflationary pressure. So if it works, it actually should result in kind of a flattening of the curve.
Yep. Well, I think a flattening of the curve means that there's less uncertainty going forward. When things seem relatively predictable across, you get that nice normal yield curve, then yes, we have a better, I think, more transparency or more understanding what's going on in the markets. When we get real big discrepancies in rates, that's when there's like, oh, I don't know what's going to happen here or there, so we'll get more.
Yep.
Let's see. You have some upcoming engagements. I know that people are always asking, and you actually put together a calendar here, so I will bring this up for you. Walk me through what you got cooking for your upcoming classes.
Yeah, I think this is the first time we've talked in years that I actually have a calendar of events that I could put together.
I like it. It's great.
So, it's nice. I'm enjoying the OTA experience. So tomorrow we've got a general XLT session. I'm doing these monthly now. And at last month's class, which we focused on those floating rate bonds, the real request was, can we demystify a lot of this jargon? So we're going to do a real Bonds 101. Let's demystify the jargon, the structure, the terminology. We'll also give some updates on the economy. I mean, I have to do that. But our main focus is going to be on, let's do Bonds 101, the pricing, this whole price-yield relationship that people don't understand. So that's tomorrow. Then on February 10th, Thursday of this week, I have a showcase, I'm going to get this right, the Signature Series Showcase. In March, I'm going to be doing the 3-day Bond Date Signature Series. And every week leading up to that, we do a weekly highlight of some of the material. And that's going to be this Thursday. And what I want to focus on for this group on Thursday, which is an open to everybody, is the floating rate bonds. And we've talked about these, Merlin. The fact that these I bonds are going to continue to offer 7.12% government guaranteed through April, when the rate will change. And quite frankly, it looks like it'll go up from there. We'll see. So the I bonds and the TIPS bonds are real interesting. If inflation's going up, which it is, we can turn that into a positive with a floating rate bond, but they require a little bit more knowledge. So on Thursday, we're going to do the I bonds and the Signature Series Showcase. And then every week on that Thursdays, we'll have another class. And then on that all leads up to March 1st through the 3rd, where we do that 3-day Signature Series Showcase itself. Woo!
Got a lot going on. Well, if anyone has access to the XLTs, general sessions tomorrow at 1 p.m. Eastern Standard Time, and then he'll do a Signature Series Showcase talking about floating rates, tips, I bonds, etc. That's going to be the 10th, which is Thursday at 5 p.m. Eastern Standard Time.
Perfect. I'm learning to market this stuff.
Good. You got to promote your stuff, man. It's funny because I think there's been a lot of OTA people that have only heard of you because you came on the show. And it's like, wait a minute, we need to do a better job.
I do, and I thank you for what you've done. Thank you.
My pleasure. Anything else? You doing anything fun and exciting other than just bonds?
I'm looking forward to traveling again. My world has been a Zoom world, which has been nice because, tonight I'm doing a class in Mumbai, India. So the Zoom world is nice that I can sit outside D.C. and teach, but I really miss the traveling. So I've got classes coming up in New York and Chicago. So with fingers crossed, it looks like I'll get back out on the road, which I look forward to. I'd even love to get into some OTA sites and see what we can do.
Yeah, absolutely. Well, I'm sure the centers would love to have you, so we'll keep pushing for that.
Cool. Thank you.
All right, Bill. Hey, thank you. It's been a pleasure. Good to see you happy and healthy. Always love the information, and go bonds.
Go bonds. But don't buy bonds.
No, definitely not.
Floating rate bonds.
All right, Bill. Well, thank you so much. Have a good one. I'll get you on next month. We'll talk more.
Sounds great. Always appreciate it, Marlon.
All right, take care.
Great job. Thank you.
Thank you.
Be well.
All right, guys. That was Bill Addiss giving us some insights into the bond market. I'm hoping, I know my audio levels jump. Every time I cut out of Skype, the volume jumps. Hopefully that didn't blow your eardrums right there. Impressive. And I think there's a lot of stuff we have to pay attention to as we go forward here. Again, what I think Bill and I have been talking about on today's show specifically is a much longer term hypothesis. I mean, it's something that could be going on for years in the U.S. equity markets. But hey, the more we keep our hand on the pulse of what's going on, the more likely we can capitalize on those moves. So hope you enjoyed that one. I know I did. I always love having him on. Again, he mentioned he's got a couple engagements coming up. Tomorrow, he's doing an XLT general session, and then on Thursday, he's doing a signature series, and then he's got weekly signature showcases and all kinds of other things. And his signature series, which is called Bond Aid, it's a 3-day bond program that he does for Online Trading Academy as well. All right. We have to talk about crypto, huh? Do we? Do we really have to talk? We probably should. I mean, finally you get to see a nice little pop in the crypto markets. But, one thing to, at least from my perspective, is you can't get so happy and all excited and think that this is it and we're all done and it's going to just start rocking from here. It is nice to see the change, though, right? Here is a daily chart. Let's get the daily charts going on. And then let's go back to the most recent data. McCormick's price target, huh? I don't remember the number exactly. I wish I would have wrote it down. If I look through this crypto space, there is a bunch of big movers here. We'll go by the update. Obviously, I have a bunch of Ripple, so watching it up 20% today, love it. But it's really, for me, more about the big ones. You want to make sure your Bitcoin and your Ethereum are doing good. Bitcoin up 4% at 44,143. And some of the things we were looking at in the Crypto Investor Live program the other day are, look, it's still in a downtrend. I mean, if we look at what happened since November in crypto, it's still in a downtrend, fairly aggressive, although this last few days has definitely shown great strength. We stabilized a little bit. Now, for me, we've got to get a close above 45,000. You get a close above 45,000, then all of a sudden we can make the argument, the contention, that this downtrend in Bitcoin is now over, and maybe we get that next surge up. But we'll see. Litecoin is the future. Believe in Charlie Lee. I don't know if it's necessarily the future. There's definitely some merits for LTC, which I do hold a lot of. Right now, still technically, Litecoin doesn't look great. You got this still a downtrend. For me, it's got to get back above 152. You need to start making some new highs here. Ethereum, not as big of a gain today as you saw in Bitcoin, and it also has some challenges ahead. 3,400 for Ethereum is the next big obstacle that I see. If that breaks, then granted, we'll probably have more upside move, but we would kind of have to wait to let this stuff pan out and see what shakes out of the tree. But right now, it looks good with some great moves up in most of the cryptocurrencies. You notice on my watch list, I've got none, literally zero, that are down for the day. That is a great thing. So obviously, my portfolio, it's prime rib and filet tonight. Let's just go get some filet mignon and some lobster for dinner. No, I'm not that type of person. Now, Margaret says, what platform do you use in CIL? It really depends on what we're doing. There's a ton of different things we can do. So I'm making trades, I'm buying, I'm selling, I'm storing, I'm moving, I'm yield farming, I'm going out and doing staking and lending. So every one of those requires a different protocol. So, you could run through, I'm using things like Crypto.com and Voyager and Nexo and Kraken and Coinbase and Binance, and it's a long list of different accounts. And again, it really depends on which ones fit your need for what you're trying to do. Big Eb says, Bitcoin, Ethereum, Cardano, Solana, Sand, DOT, and AVAX. Got them all. Got every one of those. And actually, we're almost in that order as far. You're missing Polk. Oh, you have DOT on there. It's hard to say, hey, buy this crypto versus that crypto. It's not a comparable transaction in my mind. It's like you have to really think about each one of those that Big Eb mentioned there is they each have their own strengths and weaknesses. If you look at Ethereum and Cardano and Solana, and Avalanche, those are all competing in the smart contract space. You got Sandbox. Well, now you're looking at, Metaverse. You got Polkadot. You're looking at chain bridging and trying to bring them all together. So, everyone's always got a bunch of different cryptos they like. But to me, again, it's about that portfolio construction and making sure that what I hold attacks each segment of this massive ecosystem of cryptocurrency and digital assets. So pretty excited about Capital Go ribeye. Tasty. I do like their ribeye over there. That is good. What time we got? I gotta run. I got so much stuff to do. My days are getting shorter and shorter, I will tell you that. So let's just real quickly look at what is going on with the major indexes out here. 8.8% increase for Bitcoin in the last 24 hours. Everybody's going to be loving that one. You move down the list, it's not that great for the equity markets, right? Gold was up 0.77%, but still, look where we're at. Just chopping back and forth inside of this range. It's a do nothing. And I saw a couple questions here about gold versus silver, gold and silver. I'm still holding my silver and my gold. I still think that they will benefit from inflation. I'm just not seeing it right now, but I'm patient, right? I definitely need a place to park assets if this market does in fact start to sell off, and gold and silver will be a place for me, as well as cryptocurrency. As Bill said, probably not bonds. Russell was one of the only indexes that was up today, 0.52%, but really look at it. Choppy, nothing really noteworthy there. Same with the Dow. Most of these, the Dow, S&P, NASDAQ, looking a little ugly. NASDAQ was the worst from the indexes, but technically we really haven't achieved anything new. We're not making a new high. We're not making a new low. We're just kind of consolidating, so no big deal. Oil, on the other hand, having a harami pattern today. So for those that know harami patterns, it can be a curse word in some countries. It means pregnant in others. But if you look at the lines here, I'm just going to put a line right across the low, and You know, if we get down below 90.75 on CL tomorrow, might be a nice potential shorting opportunity, but you got to wait for that to confirm. And yeah, it's definitely due for a pullback here on crude oil. I have to be obvious, not to buy back on. You have to be oblivious. Yeah, well, you know, it's not that. I think a lot of people are fearful. You know, Jerry, this is one of the challenges I have when I talk to people about cryptocurrencies. They just go, oh, it's a scam, it's a fraud, it's a scam. Well, yeah, if you look at Dogecoin and Shiba Inu and Shibu Floki and all these other ones, 90+% of cryptos are scams. They're just pump and dump things that people hope you buy. That said, that means if I say 90% are scams, 10% have some substance. And of those, I would say 3% are going to be things that shape the financial future going forward. And I just hope I'm holding it. All right, I hear Vitalik is working Dogecoin now. I don't know necessarily. I saw something about that, but I didn't see anything about him really talking about doing it. I'll have to dig deeper into it. I think he's got his hands full with Ethereum, and he could care less about Dogecoin. You know, I think that might be propaganda, but I don't know. I'll have to research and see what he actually said about Dogecoin. But he's got so much to do with Ethereum. That's his baby. That's his legacy. He's all about Ethereum. All right, with regards to earnings announcements or economic announcements, I guess I saw a comment from Big Eb saying 7.5%. I think you're assuming, anticipating the CPI number coming out. That's going to be out on Thursday. But tomorrow you do have IBD tip economic optimism numbers. You have NFIB small business index coming out tomorrow as well. And those are pretty much your only two major pieces to think about with regards to the economic calendar. Now, on the earnings front, well, there are a few companies reporting. You had Amgen report today, but tomorrow you've got Alibaba is supposed to report, but remember, they're supposed to report last Tuesday, so who knows if they'll actually report. Gotta love the rules in China. But you have BP, you've got Pfizer, and those are pretty much your two big names for tomorrow with regards to earnings. So, my friends, we'll kind of wrap it up here. Hope not that... yeah, it probably would discredit him, wouldn't it? Binance is not approved by Ontario SEC Commission yet. Oh, got to use those VPNs then to sneak around it. Yeah. Risk versus reward, it's around for a long time. Don't be fearful. Well, I guess, Big Eb, I think you would agree with this as well. Be fearful until you understand something, right? If it's new and you're scared, then be fearful. Fine. But learn about something that you're fearful of, and you'll probably overcome those worries. You know, if you've got a fear of flying, for example, well, you can look at the statistics. You are far more at risk of injury, far more at risk in a car driving down the road or riding a bicycle. So you're safer on an airplane. You shouldn't have any anxiety. So a lot of times we build up these fears about certain situations, and if we just research, look at the facts, understand something, and a lot of times that will remove whatever fears and frustrations we have and give us greater understanding. And of course, I'm not referring to just stocks or crypto. I think we could talk about just all aspects of our lives with regards to people and religions and cultures. Just learn more and be a little more understanding. All right, that's going to do it for me, everybody. I have no guests for tomorrow, so I will. I have a bunch of questions I need to get to. I apologize I didn't get to the questions that showed up in the mail, but I will get to that. If you guys have comments, questions, feedback, you can put them down below the YouTube video. That helps the most. I still owe you Les. I keep forgetting Les's question. I've encouraged Les and others to post down under the YouTube video so I can get more feedback from Google, I guess, or search results. And I try to prioritize those ones, so that's on my list for tomorrow. I will do it. There you go. All right, everybody, that's going to do it for today's show. Hope you enjoyed Bill Addiss. If you want to know more, you can check him out at Amherst Financial Education or check him out at Online Trading Academy. He's got a whole bunch of stuff going on. If you're in the XLTs, he's got a general session tomorrow you should definitely check out. That said, happy trading, everybody. I will see you on tomorrow's show. Take care.